Good day, friends. Thanks for joining us for another session on Market Outlook. We had a very eventful last 2 months. We had the Finance Minister presenting the interim budget in Lok Sabha on the 1st of February. As expected, there are no major announcements. The primary focus of the market was on what kind of fiscal deficit number gets penciled in. The Finance Minister stuck to fiscal discipline, with the fiscal deficit for this year turning out to be actually lower than what the analysts were expecting. The Finance Minister has promised that the economy will be on the glide path of fiscal consolidation, and the fiscal deficit has been pegged at 5.1% for this year and 4.5% for the next year. We have seen bond yields cooling off as a reaction to this. Also, we have seen the infrastructure spends have continued to be extremely strong. This year, again, we are expected to see around 11% increase in infrastructure spending and this is coming on the back of more than 25% increase in infrastructure spending in the last financial year. All this will go a long way in improving the physical infrastructure in the country, and in terms of energy, power, both renewable and fossil fuel based, improving port infrastructure, improving connectivity through roads, and setting up a lot of metro networks in various large cities. Our assessment is that the capex drive related companies should continue to benefit from this spending by the government of India and by major public sector enterprises, and which should show up in earnings growth momentum for these sectors. Also, as the bond yields cool off and the inflation has been coming under control, there is an expectation that interest rates will get cut in the second half of this year. We also had the RBI policy this week, in which while the interest rates have been kept at the status quo level, but there is an expectation that as the inflation cools off further from where we are, we should see interest rates cut happening in the second half. We have already seen bond markets reacting to it, with bond yields cooling off by 25 to 30 basis points in the last 6 months. Our sense is we have seen the peak of the EMIs, as far as home loans and personal loans are concerned, and hopefully, post June we should see some, cool off in some of these rates, which is going to be a big positive as far as the overall growth, momentum in the economy is concerned. RBI has also upgraded the GDP growth target for FY25 from 6.7% to around 7%. And for FY24 also, we expect GDP growth to be upwards of 7%. So India looks like we would have a stable regime of 6.5% to 7% kind of real GDP growth, around 4 to 5% inflation. That should lead to a normal GDP growth of around 11 to 12%. And in that environment, we expect corporate earnings to grow at the same level. Broadly, we expect equity markets to also track the earnings growth momentum in the economy. And as such, we expect markets to continue to do well from a medium to a long-term perspective. In the short term, yes, we have seen concerns about valuation. Overall, market is trading at around 20 times 1 year forward earnings. However, there are some pockets which have become expensive. We continue to have a liking for sectors like banking and financial services, select capital goods stocks, IT, pharma, and media, which we believe should do quite well in the next 12 months. With this, we will end this month's market commentary session. Thank you everyone for joining, and hope you have a great month ahead.